Hi, this is James with Full Capital, and this month's August multifamily financing and investing webinar. The theme is acceptance, and so after listening to a lot of the quarterly calls and also just talking with clients, I think this theme fits. Um, here was the president of an agency lender on a recent call. And, here's what he said. Borrowers and lenders have tried to wait this market out, market dislocation, hoping for rate cuts and better days. We might see a couple rate cuts. Today, they haven't happened, right? And to date, they haven't happened. And what's next is likely a period of acceptance. And so I highlighted that in green. There's just a point where investors, regulators, banks are going to say enough is enough. You originated this loan 5, 6, 7 years ago, and the pretend and extend just doesn't work anymore. So you can pretend so long, but the clock is running low on pretend and extend. And this is from a bank that did a lot of bridge loans in 21 and 22. But I think what you'll see in this webinar is a shift on how these bridge loans are being originated today that we'll go through. All right, so here's the agenda for the webinar. We're going to go through sales trends that we're seeing here in DFW, and then talk about the sort of REO foreclosures that we're seeing, the lender appetite for new deals. So we're gonna go through two calls with two of the top lenders on the multifamily side, and then also two of the top owners, really in Sunbelt multifamily, and see what they're seeing, and then wrap up with just a few comments on what we're seeing on the lending side. So if you want a copy of the slides, hit that subscribe button on YouTube. Email me here at jeng@oldcapitallending.com, and I can send you a copy of the slides. All right, just quick on my background, if you have not heard from me. Born and raised in Houston, went to school at UT, been here in Dallas for the last almost 20 years. Started my career really at GE Capital, worked in the real estate group for almost 10 years as an underwriter, and then the last 10 years really at Old Capital, originating multifamily loans. Done about 1.6 billion, and then invested in a lot of properties, really all throughout Texas. All right, so this is our big event coming up in about 2 months. Old Capital Conference. Will be our ninth annual Old Capital Conference. So if you're interested in Dallas, if you're interested in multifamily, this is really the place to be. This year we are hosting it at the FC Dallas soccer stadium up here in Frisco. So go to oldcapitalconference.com and you can register for that event. All right, so this is a snapshot of some of the foreclosures that are hitting right now. And if you want a list of all the Texas foreclosures or foreclosures in your market, feel free to email me. I can send it to you. But this pace is picking up in terms of foreclosures. So what we talked about in terms of acceptance at the beginning of the webinar, banks are getting to the point where the borrower that started in 21 and 22, they're just running out of time, running out of capital, and they're asking people to pay down these loans, buy new interest rate caps, and it's just not happening. So the lender has got to protect their collateral, which is what we're going to see. So these are a couple of the more recent ones that we've seen, and so this is hitting everybody. I mean, you're seeing a lot in the BNC space, but this is a Class A deal in Plano that got foreclosed in May of this year. Or sorry, in July of this year, from a loan that was originated in May of 2022. Very large property, 324 units, but huge loan amount, right? So that's a big price per door that they're going to have to work through. Here's another one that just got foreclosed in June. Same story, bridge loan done back in August of 21, right? So another is a B property, 325 units. So this is impacting A, B, C properties across the board. All right, so I think this is what is interesting is, we've seen, if you go back to the slide, we've seen this happen where the lenders are taking back properties, but we didn't know how they were gonna move those properties. Were they gonna hold them for a long term? Were they just gonna foreclose and flip them out? And so now we are starting to see these deals come to market through brokers, right? So you see 772 units REO. These are all within, I would say, the last 30 days of short sales in whether it's San Antonio, Fort Worth, Houston, all throughout the major markets in Texas that these deals are coming to market. And, you know, you're going to have to talk to the individual broker and figure out, are they going to take a discount to the loan? Are they going to help us by financing a lot of the rehab or basically give you 100% loan to value? So it's just going to depend on the lender and what their appetite is to staying in the deal, right? So once we get into the lender calls, you're going to see how some of these deals are being put together. But these are starting to come, which I think is encouraging, and also in terms of acceptance and clearing the market, I think these will help if they actually sell. All right, so here's a look, sort of year to date DFW, and this shows a lot of 126 properties. Uh, a big concentration on the A space, really a majority versus the B and C space. But I would say a lot of these also, I don't think there's been this many sales. Some of these sales that were picked up by Yardi, some of these were like the HFC deals that were done. Some of it was the preferred equity taking over the property, things like that. So this number might be a little bit higher than true sales to a third party. But I just wanted to give you a feel for transactions happening in DFW. And so definitely higher concentration on the A side. And then a lot of these sales were picked up. If you look at the bottom here, bottom right, a lot of these deals, like when you say, oh man, so much is traded in DFW, but a lot of these portfolio deals, there's just a lot of apartments in DFW that were part of those transactions. So the conventional sales was less than half, and that was sort of your one-off deals. All right, so how are deals getting done right now? Here's an example of a deal where 500 flats, this is a deal in East Fort Worth. They gave a loan in 22 of 25.5, and now they're just sort of re-extending that loan, right? And Electra came in, and they were either the pref equity because they did a larger portfolio where they took over a lot of positions, where the original general partner maybe put in some money, but then the pref equity is coming in and taking over the deal. So that's bridge to bridge. Here's another one up in Northlake where Starwood gave a $58.6 million loan for the original purchase. I think it was to Tides here in January 2022. And then now they are cutting a new loan, probably pretty close, probably more advantageous than anybody else in the market could do in order to probably not write off this loan balance of 58.6. And they sold it to a third party. All right. And then, so this is what we're going to see a lot more of. And so we're seeing a lot of developers. They took a construction loan in 21, 22, 23, and now they want to stay in the deal. And, a lot of bridge lenders, so they either want to stay in the deal or they're going to sell the deal. And on this particular case, the bridge lenders are coming in, and the spreads that are happening on these sort of bridge construction takeouts are probably some of the most aggressive for bridge. And we're going to see why in the comments here shortly. So here also with this is the deal Ashton that was up in Saginaw. So we're seeing that deals that are coming to market, a lot more people are taking agency, and you're seeing the reset basis, right? So you've seen historically for the last, 15 years, from sort of 2008 all the way up to 2022, every year the loan amount was increasing, from 3 million to 11 million to 18.5 million. And now you're seeing these reset bases, right? Where people are sort of capped based off the DSCR of these Fannie Mae loans. and they're probably paying pretty much close to the debt right now on these reset bases. Or if the person has owned the property for a long time, this one was, they owned it since 2016, and now they've just been in the deal for a long period of time, and it's time to sell. And so those deals are selling as well. So we're seeing the reset basis off of bridge loans, and then we're also seeing stabilized long-term earners. They missed the peak. They wish they could have sold in 21 or 22. They missed it. It's been 2 or 3 years, and now it's time to go. All right, so we saw payroll come out, or the jobs report come out very light, and the revisions light. So the percentage chance of a cut at the next meeting has moved to about 80%. So that's one cut, and then potentially we're over 50% on the second cut in October. So I think that will provide a little bit of relief on the floating rate side, a little bit of relief on the interest rate caps. But a lot of that movement was reflected in the treasuries almost right away. And so we saw 10-year, you see this last little dip here in the back in this month. We saw about 20, 25 basis points come off the 10-year. And we also saw that on the 5-year. And so, people are looking at this and saying, look, spreads are pretty tight on the agency side. We did an index lock on a Freddie deal, pretty much on a 5-year deal. It was about 370 or 380 plus, let's say 120 with a buy down. So you're all in at about 5%. And so even though these base rates feel a little bit high, just compared to your recent past in 21, 22, your spread is pretty thin. And so your all-in rate at 5%, that's like what we were locking rates at in 17, 18, 19 when we were doing a lot of Fannie Freddie deals. And so that feels pretty good for a lot of people. And if you're able to, come pretty close to your existing loan balance, doing that 5-year refi on a lot of bridge loans is what a lot of people are doing right now. All right, so let's get into some of these calls and what people have been talking about. And we're going to start with Arbor. So Arbor, they were doing $1 billion in bridge loans a month in back in 21 and 22. So they have a large exposure. But it's been challenging, right? So they're saying, look, this rate environment that we've talked about for the last 3 years. Here's 5-year Treasury sort of stuck at around 3.5 to 4.5% on the 5-year. It's been challenging for people to recap their deals and move to fixed rate loans. It's going to be challenging for them because as they take back these deals, they're basically taking a deal that is performing, a loan that's performing, and now they're going to have to run that deal. And usually it's not cash flowing, right? And so they're trying to just get this behind them, and they're going to be a lot more aggressive about taking back these properties. They've seen when they've talked to agencies, Fannie and Freddie, even they've seen an increase in delinquencies. And then in San Antonio and Houston, with Trump's stance on immigration and how aggressive they've been on a lot of these migrant issues. So they're seeing a little bit more economic occupancy stress in those two markets of San Antonio and Houston. Their delinquencies were about 529 million compared to 654, so that's come down, but some of that just moved to the REO bucket. And then so they're going to continue to take back these REO assets. But on these modifications, they've essentially asked people to do 4 things, right? So one is put in additional deposits for interest reserve, either renovation, debt service reserves, things like that. Number 2, they want you to buy a new rate cap. Number 3, they want you to pay down the loan. And number 4, if you're delinquent at all, catch up your interest. And so on these deals, I mean, these are large deals, right? And so these can be, the new rate cap can be like 2% of the loan amount. If they have you pay it down by any amount, you got to catch up your interest. So this could be like $2, $3, $4 million. And so going back to the investors for another $2 or $3 million is difficult right now. And so that's why you're seeing, these lenders propose these things. They say, no, borrower can't do it. Then they're having to take them back. And so this was the largest section of the call talking about REO, right? So this is what I want to focus in on is so they took 188 million back in REO and 115 they just gave to a new guy. So the first borrower that bought the deal in 2021, 22, they're out and they're going to bring in somebody new. And that new person assumes the debt. And then usually that new person is bringing those things like CapEx, they're bringing interest reserve, those things in order to really improve the asset. And so they Arbor's anticipating about 400 to 600 million in REO assets that they're going to continue to operate and really try to get these from non-performing loans into interest earning assets. But they did talk about initially, like we saw some deals go bad in Houston that Arbor had to take back, and they were very, very deep value add in terms of occupancy was 50, 40, 30%, and just bad operators. But they're saying the more recent stuff that they're taking back, the occupancy is not bad, right? Occupancy is 80%, 90%, and they don't think they're going to hold these that long, right? So they're gonna foreclose because the new borrower can't put up any additional reserves, like we talked about those four things. But they're going to transition them really to somebody else very quickly. And if someone can come in, assume that loan, they're going to move it over to that person. All right, so here's a couple of examples of deals. And this, I think I had to dig a little deeper. So this was not in the quarterly call. I think this was in like the 10Q part of it. Okay, so they had about three properties in San Antonio in June that had about a $78 million loan balance. And the interest rate was 525 approximately. And then they had already put up reserves against it, but then they foreclosed and then they sold the properties for 65 million. Okay. But they also gave a $65 million bridge loan and the rate was SOFR plus two. So SOFR right now is like, let's say 425 plus two. So you're 625 for the first 2 years and then SOFR plus three. So if SOFR goes down a little bit, which is what people are expecting, you're probably around 6%. But it has a subject, it has a floor for these. So it's going to be 25 for a couple of years, and then probably go to 725 if I do my math, or 825. So it's obviously the LTV is very high, and so the pricing is a little bit higher. But for 100% LTV, you usually would not get this pricing, and so they had to adjust the price a little bit in order to, because this was sort of accretive financing, way too accretive financing that normally will. So I tried to dig a little bit into what exact properties these were. These were two of the properties that sort of popped up in San Antonio that Arbor had loans on. One was over, these are B deals, 318 units, 319 units in San Antonio, and they just moved them over really to a new borrower and sold them. So foreclosed and sold them quite quickly. Here's another deal in Austin where they foreclosed in April, had SOFR plus four, and then they ended up selling it for right around the balance, and then provided pretty much 90-95% bridge loan at SOFR plus two, SOFR plus three on the deal as well. So you can see that going back to the slide, Arbor's coming in, even though these properties are like this one, let's see, this one's 86% occupied. But the new or the old buyer just cannot put up that additional money that they're requesting. And that is allowing new borrowers to come in and buy those assets and assume those loans. All right. In terms of the loan originations, they haven't really done a lot of bridge this quarter, 100 million, but they did a lot of agency, 850 million, and a lot of that was going through Fannie, and they, Arbor has done a lot of bridge loans, and they also have agency lending. And at the end of the call, they're like, "Well, now we have someone else trying to replicate that," and The guy that's doing that is a group called Franklin Benefit Street Partners. And so I listened to their call, and that is where the theme of this this quarter's market update really came out, and they were talking about the period of acceptance, right? So everyone's been waiting, borrowers, lenders, waiting for rate cuts, waiting for treasuries to come down, waiting for insurance, waiting for taxes to get better. Um, but they're like, look, unless the 10-year comes has a three handle on it, right? Which happened for about 5 minutes this year, very briefly. Expect 5-year and 7-year duration loans to dominate and are even shorter, right? And so, we've done a lot of whether acquisition or refis, and pretty much everyone's going 5 and 7 year agency right now. But this was an interesting take on, where they saw a lot of the bridge loans going. A lot of the 70s and 80s vintage stuff, they financed a lot of it back in the day, but then like back in 21 and 22, but you're not seeing a lot of that stuff trade. And the reason is this cap rate tiering, right? So let's say A stuff's at 5%, B stuff's at 6, C stuff's at 7% cap rates. And they're like, this is the correct dynamic. It supports more rational equity investing and lending. And let's see. Okay, so this is where they were talking about. They're like, look, we don't want to call a bottom yet. That's dangerous. But so much property valuation decline has happened in the last 2.5 years. They're like, look, if we aren't at the bottom, we're pretty darn close. So a lot of people are stepping in right now. And this is a quote that we had at the beginning. You can only pretend and extend for so long. So you're just running out of time. So this was interesting when they talked about, all right, what are we originating in terms of bridge loans right now? And in 21, a lot of the stuff was 80s, 70s, 80s, 90s, and they were putting 10,000 a door, and they were going to move rents $200, and then they're going to sell it 2 or 3 years later. But today, what they're putting on their balance sheet is new stuff, right? So new vintage multi. So all the stuff that was built in 21 and 22, and there was a construction loan that's coming due. That rate is 8%. But they need to get out of that stuff. And so the developers either refinancing that stuff or they're just selling it. And someone is coming in and buying this deal. So a lot of their bridge stuff has been 5-year-old assets, and there's no business plan. There's nobody's doing anything on the construction piece. This is more a bridge in time versus bridge in adding value. So new construction loans are getting paid off, and the asset quality is significantly better. And they talked about spreads, how spreads have just tightened everywhere, whether it's CMBS, whether it's agency. They're saying, look, there's a lot of liquidity in the system. And when there's a lot of liquidity, people keep bidding and bidding and bidding until you get these super low spreads because there's just not enough product to buy. So they originated about 61 million. They're going to pick that up because they bought New Point, which is a large agency lender. But look, they're basically taking back some of the stuff that they originated in 21 and 22, and they're basically selling it for the loan balance. So if they can take it back, sell it at the loan balance, then they're happy. They've taken 19 properties back, 560 million, and that's pretty much what they sold it for. So here's some of the deals that are on their watch list. A lot of these deals you can see were originated in 2022, whether it's in Fort Worth or whether it's in San Antonio, in terms of apartments. So risk rating of 4 and 5. So I guess 1, 2, and 3, you're okay. 4 and 5, you got to disclose. So they disclosed these two properties in Texas. And then, what's happening, as they foreclose, they maybe stabilize the property and then list it up for sale. And so they're going to do these with these other two as well. So let's go from the lending side, even though lenders are a lot of the activity in today's market, and go over to what operators are seeing. So Camden, I want to say they have 50, 60,000 units throughout the Sun Belt. And, look, they're like affordability continues to improve because rents have essentially been flat the last 2, 3 years, and wage growth continues to go up. So it's actually the tenant is actually in a better position. High cost of ownership, rental rates, they think should start firming up here in 2026. And they're starting to sell a lot of their older stuff, older being, A minus stuff, and move into the newer stuff. But they said they did it and other operators did it, but really the last 3 months, they haven't been pushing on rate at all. They've been focused on occupancy. So occupancy on a lot of these properties are 95% for Camden. And one of the analysts asked them, what does this time remind you of? And one of the guys at Camden basically said he thought it felt like 2010, right? So 2008, markets were down, 2009, markets were down. And it really wasn't about, it's really about demand in that picture. But here he's talking about, look, rents have been flat because we've had this oversupply, but we have not lost demand. And, they think just getting to 1% is good. And they're seeing starts in their, Sun Belt markets down, 50 to 75%. And so they think, next year is really the beginning of this rental rate increase, and they have a forecast of 4, 5, 6% rent growth in some of their markets. But for now, new leases are still down 2%. Renewals are up about 4, so they're pretty much flat. As a lot of the renewals, like 60% of their tenants are renewing right now, so more are going to that higher blended rate. Um, and then their expenses seem to be about, we always underwrite 3% or 3% expense growth typically. And that's actually what they're hitting right now, because taxes and insurance have been pretty much flat or down, over the past year. Here's some of the markets. These are the markets I just highlighted, the Texas ones, in terms of growth. Employment growth still going for the next couple of years. Population growth still strong. So all your major Texas markets are in the top 10 for employment, population, and migration. And then the second owner that really is in similar markets, MAA, similar story. Their absorption's still high. They have not bought a lot on the acquisition side. And they talked about really in the second quarter, there was a lot of uncertainty, I think, with the tariffs, people being a lot more selective, and they focused more on occupancy than trying to push rate. But they're still seeing negative rent trade outs on the new leases, even in the back half of the year. And then they're going to push occupancy for now until they really get to probably 95, 96% occupancy. Or sorry, yeah, they're not going to push rate until they get to 95, 96% occupancy. And then, even when so a lot of these REITs, they not only acquire properties, but they also are in the development space. And so, they're always looking at equity packages and saying, hey, does this piece of dirt work? And they're trying to get to a yield that is above your cap rate, right? So if cap rates are, let's say, 5% on A stuff, they're really trying to get to a yield of, on this, they're saying 6.5 to 7% to make that spread. And they aren't there yet. So when they look at it, construction costs need to come down, rent growth need to improve, in order for that construction to make sense, right? So we just haven't seen development take off yet. So something's got to give in terms of interest rates have got to come down, construction costs got to come down, or the rents have to pick up in order to make that equation work. And there's no equity for the developments right now either. So you're just going to see this hole in the supply for a while. All right, so we've talked through sort of like transactions. We talked through what the big lenders and owners are seeing, and then now we're going to get into how these deals are getting financed. And whether it's bank loans, Fannie or Freddie, or bridge loans. All right. So on the bank loan side, we're still doing smaller deals. So I would say 5 million and under bank loans that maybe either someone's a first time owner and they have a good W-2, or their spouse has a good W-2 and they're just getting into the business. You might have to bring over about 5 to 10% of the loan amount in deposits to the bank. But these deals are getting done and they're slowly coming down, a little bit lower than prime right now on these deals. All right, Freddie Mac SPL continues to be competitive. People continue to use them. Their rates, they have not moved rates down as quickly as this last drop, right? So on the SPL side, we saw, if you're locking a Fannie Mae deal, it moved quickly. Freddie Mac has essentially held their pricing, and they're anywhere from 6.25 up to 7% right now. On the Freddie Mac conventional side, they've done about 25 billion year to date. Um, on the conventional side, we just locked a 5-year deal right around 5% with the buy down. And then, on a 7, you're probably 525, and 10, you're, depending on the spread that you get, probably 525 to 5.5. And so, there's a big emphasis on property condition. They're looking at all the SAR stuff, SREO stuff, and they want to make sure that your performance on not only other loans, but Freddie Mac loans have been good, and they still allow pref equity behind the first mortgage. Fannie Mae, this was a deal that we closed out in Fort Worth. So we did a 7-year fixed term, essentially 65% full term IO deal. And Fannie Mae had a good second quarter. So they did 17 billion, which was up from 9 billion in the second quarter of 24. And then compared to first quarter, they did about 11.8. So 29 billion so far from Fannie. And, I think on the Fannie side, just being in position, right? So a lot of people who have bridge loans or just old Fannie Mae loans that they need to refinance for the next, let's say in the next year or two, we're doing third parties early. We're making sure that you're in position so that when you do see that 20, 25 point drop on your corresponding treasury, 5 or 7, you're able to lock the rate pretty quickly. And non-recourse bridge, I mean, a lot of our buyers in the smaller space on the BNC space really aren't doing a lot of bridge unless it's required and you're getting a pretty good deal from the existing lender who to come in and buy that property at a higher loan amount. You're seeing what Arbor was quoting, SOFR +2, SOFR +3, and I think this is probably more on the larger side. So if you're buying a Class A deal and you have a certain down payment, you can use this as sort of that bridge in time versus you don't want to get locked into a expensive agency with a big prepay right now. Is a lot of people using that non-recourse bridge. On the on the whole capital side, when I started, a lot of people were doing Fannie and Freddie fixed, then they went to bridge, then they went to floaters, then they went back to bridge, and now we're back to Fannie and Freddie. So just understanding, someone who understands the entire space, I think is important, working with you, educating you at the beginning, representing you, the buyer, throughout the entire process, connecting you with vendors, anybody in the space that you need. And then what we're seeing now is more on the asset management side. Like, after the deal closes, you need help with servicing. Those are the types of things that we're doing. A reminder, if you made it this far, then you should definitely be at this conference because this is all we're going to talk about for 2 days. So we have a happy hour on Wednesday night, and then on Thursday all day, pretty much listing brokers, lenders, owners, all in one spot in DFW. So go to oldcapitalconference.com to really sign up for that one. All right, so subscribe to the channel, like the video, comment on the video, what you're seeing out there. If you need help on your deal with an upcoming loan maturity or a new deal, or help reviewing a deal on the equity side, feel free to send it over. And if you're looking at setting up or getting into multifamily, Send me an email. I'll send you sort of our PFS, personal financial statement template, and then we can set up some time to talk. But thanks a lot for watching, and I'll see you next quarter.